Welcome to Get Solutions. So in previous classes, that is in previous sessions, we have discussed regarding the various industries based accounting standards. So those standards related to agricultural producers and biological assets and insurance contracts and deferral account balances and the accounting standard related to exploration for and evaluation of mineral resources. So in this module, that is accounting and reporting for business combinations as per Indian Accounting Standard 103. So in this module we are going to discuss how the business organizations that will meet the definition of business combinations and how these business combinations will be going to adapt the accounting policies and reporting their financial statements as per Indian Accounting Standard 103. So before going to know about the objectives and scopes and disclosures of Indian Accounting Standard 103, first we are going to discuss and first we have to know what is business combination. See, the business combination is a transaction or a event where an acquirer obtains the control of one or more business organizations. So I will give you the example. For example, there is a company A and company B. Assume company A purchasing assets and liabilities from B company. See, company A purchasing assets and liabilities from the B company, so that the A company will give some payments in the form of money or shares or debentures to B company. That will be called as purchase consideration. So that you have studied in your BCom. Okay. So A company purchasing the assets and liabilities of the B company, then A company becomes a acquirer company and B company becomes acquiree company. Assume the A company purchasing the assets and liabilities of the B company, then A company is acquirer company because it will be going to acquiring the assets and liabilities from the business B. So A company is called as acquirer company and B company will be called as acquiree company. Now A company has a right to control the assets and liabilities of the B company. So in this example, you have to know the relationship between the acquirer and acquiree and who is acquirer and who is acquiree. So this is very important to understand the concepts under Indian Accounting Standard 103. Okay. See, the company business combination is nothing but a transaction or a event where an acquirer obtain the control over assets and liabilities of the one or more business organizations. Means, so ಯಾವಾಗ ಒಂದು ಕಂಪನಿ ಇನ್ನೊಂದು ಕಂಪನಿನ ಕಂಟ್ರೋಲಲ್ಲಿ ಇಟ್ಕೊಳ್ಳುತ್ತೋ, ಸೊ ದಟ್ ಪರ್ಟಿಕ್ಯುಲರ್ ಸಿಚುವೇಶನ್ ವಿಲ್ ಬಿ ಕಾಲ್ಡ್ ಆ್ಯಸ್ ದ ಬಿಸ್ನೆಸ್ ಕಾಂಬಿನೇಷನ್ಸ್. ಅಂದರೆ ಅಸೆಟ್ಸು ಮತ್ತು ಲಯಬಿಲಿಟೀಸು ಬೇರೊಂದು ಕಂಪನಿಯಿಂದ ಪರ್ಚೇಸ್ ಮಾಡಿಕೊಂಡಾಗ ಆ ಪರ್ಟಿಕ್ಯುಲರ್ ಕಂಪನಿಗೆ ಇನ್ನೊಂದು ಕಂಪನಿನ ಕಂಟ್ರೋಲ್ ಮಾಡೋ ಕೆಪಾಸಿಟಿ ಬರುತ್ತೆ. ಸೊ ದಟ್ ಸಿಚುವೇಶನ್ ವಿಲ್ ಬಿ ಕಾಲ್ಡ್ ಆ್ಯಸ್ ಬಿಸ್ನೆಸ್ ಕಾಂಬಿನೇಷನ್. ಸೊ ಅಂಡರ್ಸ್ಟುಡ್? ಎಸ್. Next, the Indian Accounting Standard 103 business combination prescribes the certain rules and regulations for recognizing and measuring the principles for business combinations by acquisition and merger. See, this Indian Accounting Standard 103 gives the certain rules and regulations and prescribes the certain principles for recognizing the transactions which related to business combinations and measuring the transactions which completely related to the business combinations. How? In the sense, by entering into the acquisition and merger concepts. And also this standard deals with the accounting combinations of entities or business under common controls. So this Indian Accounting Standard 103 not only applicable for the business combinations and also for acquisition and merger, and also this Indian Accounting Standard 103 applicable to the various entities, that is when the entities have the control rights to control the assets and liabilities of the another company. So ಈ ಒಂದು ಇಂಡಿಯನ್ ಅಕೌಂಟಿಂಗ್ ಸ್ಟ್ಯಾಂಡರ್ಡ್ 103 ಬಂದು ಅಕ್ವಿಜಿಷನ್ಸ್, ಮರ್ಜರ್ಸ್ ಆರ್ ಅಮಾಲ್ಗಮೇಷನ್ ಅಂಡ್ ಅಬ್ಸಾರ್ಪ್ಷನ್ಗೆ ಅದಕ್ಕೂ ಅಪ್ಲಿಕಬಲ್ ಆಗುತ್ತೆ. ಆ್ಯಂಡ್ ಆಲ್ಸೋ ದಿಸ್ ಇಂಡಿಯನ್ ಅಕೌಂಟಿಂಗ್ ಸ್ಟ್ಯಾಂಡರ್ಡ್ 103 ಅಪ್ಲಿಕಬಲ್ ಟು ದ ಎಂಟಿಟೀಸ್, ದೋಸ್ ಎಂಟಿಟೀಸ್ ಹ್ಯಾವ್ ದ ಕಂಟ್ರೋಲ್, ದಟ್ ಈಸ್ ಕಾಮನ್ ಕಂಟ್ರೋಲ್. ಬೇರೊಂದು ಕಂಪನಿನ ಕಂಟ್ರೋಲ್ ಮಾಡೋ ಒಂದು ಎಬಿಲಿಟಿ, ಒಂದು ಕಾನ್ಸೆಪ್ಟ್ ಏನಾದರೂ ಇದ್ದರೆ ಆಗ ಇಂಡಿಯನ್ ಅಕೌಂಟಿಂಗ್ ಸ್ಟ್ಯಾಂಡರ್ಡ್ 103 ಅಪ್ಲಿಕಬಲ್ ಆಗುತ್ತೆ ಅಂತ ಹೇಳ್ತಿದ್ದಾರೆ. ಓಕೆ, ಸೊ ಇನ್ ದ ನೆಕ್ಸ್ಟ್ ಸ್ಲೈಡ್ಸ್ we are going to discuss how, that is when the Indian accounting standard is applicable and when the Indian accounting standard is not applicable. So that is the scope of Indian accounting standard 103. So the first scope, see, this Indian accounting standard applies to the transactions or the event that meets the definition of the business combinations. So what the scope says, in the sense, when the business organizations meets the definition of the business combination, that is when the business organization that must satisfy the conditions of the business combination, then the Indian accounting standard 103 is applicable. If not, it is not applicable. Let's see the criteria where it is applicable and where it is not applicable, on what situation it is applicable and what situation it is not applicable. So this Indian accounting standard applies to all the transactions or the various events that meets the definition of the business combinations, which means when the business organization has the control over the assets and liabilities of the another company, then that situation will be called as business combinations. So that business organization meets the definition of the business combinations, then the Indian accounting standard 103 is definitely applicable. If not, the criteria will decides where it is applicable and where it is not applicable. Let's see the criteria where the Indian accounting standard is not applicable. So under that, first one, the formation of joint venture. So all of you should know the definition of joint venture. So the meaning of joint venture generally. So what is generally the joint venture, in the sense, so joint venture is nothing but 50-50 ownership, that is joining the management to share the profits. So in this case, both the companies are engaged in the takeover of the business. So both the company will be going to share the profits and losses equally. So in this case, both the companies has the control to manage the business. So on those situation, the Indian accounting standard not applicable. So joint venture does not meet the definition of the business combination, so that the first scope tells that in those joint venture situation, Indian accounting standard is not applicable. Okay, so the second one, the acquisition of assets or group of assets that does not constitute a business. So this scope we will discuss in the next slide. Okay, see, acquired company, you know, so which company purchases the assets and liabilities of the another company, so that company will be called as acquired company. See, the acquired company is related to business. There are two situations in this. The company purchased the assets and liabilities from the another company which engaged in the business. And another situation, the company purchased the assets and liabilities, that company does not engage in the business. that is only assets or group of assets. So understand carefully, this is the acquired company. The company purchased the assets and liabilities of the particular company. That company completely engaged in the business. Okay, so another business organization, so it is not a business organization. Assume in another condition, the acquired company purchasing the assets and liabilities from the another person. So that person not engaged in the business. Okay, so see the examples I have given below. If it is engaged in the business, then it surely entered through the merger and acquisition. If it is engaged in the business, then the acquired company purchased the assets and liabilities of those business through enter into the merger and acquisition concept, or in the form of business combinations under common control. If the company or acquired company or any of the company purchase the assets and liabilities from the another business, if it is not engaged in the business, then it will be purchased only a group of assets which is not related to business, then it surely entered into the joint venture. Therefore, the Indian Accounting Standard 103 does not applicable to joint venture, and it is applicable to mergers or acquisition and combination of the business under common control. So ultimately the scope tells that when the business organization meets the definition of the business combination, or when the business organization meets the definition of the business combination, then Indian Accounting Standard 103 is applicable. If not, it is not applicable. That is, when the business organization purchase the assets and liabilities from the another business organization, or when these assets and liabilities are related to the business, then IndAS 103 is applicable. When those assets which is not related to a business, then 103 is not applicable. I hope all of you should understood. So before going to know about the business combinations under Indian Accounting Standard, it is better to understand the basic difference between Accounting Standard 14 on accounting for mergers and Indian Accounting Standard 103 on business combinations. Why means, because the Indian Accounting Standard and accounting standard is most cases are similar accounting policies, but there is a slight difference between Indian Accounting Standard 103 and accounting standard 14 that you have studied in your third sem corporate financial reportings, right? So let's see what is the difference between or slight difference between accounting standard 14 and Indian Accounting Standard 103. Now let's see the differences between the Indian Accounting Standard 14 and Indian Accounting Standard 103. Okay, see, this Indian Accounting Standard 103 related to the business combinations, right? So this Indian gap is nothing but accounting standard, that is accounting for amalgamations. Okay, so under that first difference, when an acquirer obtain the control one or more business, then the Indian Accounting Standard 103 gives the guidelines on common control. That means when the business organization obtain the control from one or more business organization, then the Indian Accounting Standard 103 is the responsible to give the guidelines to measuring and recognizing the transactions that those transactions related to the business combinations. So under this Indian GAAP, that is related to Accounting Standard 14, there is no comprehensive standard dealing with the all business combinations, but the guidelines for the amalgamation concept is available in Accounting Standard 14, which means the accounting for amalgamations. And also we have the guidelines related to this amalgamation concept under Accounting Standard 15, so which is deals with the investment in subsidiaries. So when the company invested in the subsidiary, then also the company which will be going to invest in the another company has a control on assets and liabilities of the another company. So that this is the Accounting Standard 14 and Accounting Standard 15 is the similar concepts. So the concepts related to the amalgamation and merger. So that this Indian GAAP, that means Accounting Standard 14, the rules and regulations will be available in both 14 and 15 accounting standards. But according to Indian Accounting Standard 103, when one company obtain the control of the another company, then the whole responsible of Indian Accounting Standard 103 is gives the principle or guidelines for recognizing and measuring the business transactions as per 103. So the second difference, the date of acquisition is the date on which acquirer obtained the control of the acquired company. So which means when one company obtain the control, that means when the company purchases the assets and liabilities on a particular date of the another company, so that particular date will be called as the acquisition date according to Indian Accounting Standard 103. But in Accounting Standard 14, with reference to the legal mergers, the appointment date is agreed in the scheme of amalgamation. The effective date is the date of filling the court sanctioning order. So in case of amalgamation, the courts will be going to mention the sanctioning order. So on which date the court will be mention the sanctioning order to sell or purchase the assets and liabilities from the one company to the another company. So that date will be called as the acquisition date according to Accounting Standard 14. But in this case, Indian Accounting Standard, when the single entity purchase the assets and liabilities of the another company, that date will be called as date of acquisition according to Indian Accounting Standard. But according to amalgamation, that is Accounting Standard 14, until a court sanctioning order, there is no date of acquisition. Okay, so these are the slight difference between the Indian Accounting Standard 103 and Accounting Standard 14 or Indian GAAP. Next, we will see the objectives of Indian Accounting Standard 103. A reporting entity must be ensure that, okay, wait one second. Okay, a reporting entity must ensure that the accounting and reporting for a business combinations. So when the company must be present the financial statement to the authorities, it must be carefully observe the reporting and accounting policies of the business combinations, because these reports focuses on the accounting required, because these reports must be satisfied the certain conditions, and also it includes the certain rules and regulations and accounting policies according to US GAAP, such as, let's see what are the objectives of Indian Accounting Standard 103. So it must be include the scope. That means the Indian Accounting Standard is applicable to which business organization, or for which business organization the IndAS 103 is applicable, and for which business organization it is not applicable. That must be included. Okay, so secondly, an acquirer accounts for a business combination using the acquisition method. The four basic steps in the acquisition method are as follows. For example, if the business organization engaged and meet the definition of the business combination, then an acquirer must be follow the acquisition methods. So it includes the four steps in the report. That is, first one, we are going to determine the acquirer. That is, I already explained in the example who is an acquirer and who is an acquiree, and also we have discussed that is the relationship between acquirer and acquiree. So first we are going to determine the acquirer, who is an acquirer and who is an acquiree. Okay, so secondly, determine the acquisition date. So secondly, we are going to determine the acquisition date. Okay, so according to IndAS, so which is acquisition date, in the sense the acquisition date is the date on which an acquirer obtained the control of the acquiree. Okay, so this is this acquisition dates have the difference in the Indian Accounting Standard 103 and Accounting Standard 14. So that we have discussed in the differences. So if you don't know, please go back and see once again the difference between the Indian Accounting Standard 103 and Accounting Standard 14. So if so, second one, an acquirer accounts for a business combination using the method. They must be follow the four steps in the acquisition method. Let's see the acquisition methods. So determine the acquirer, I have explained earlier. Next, the second one, determine the acquisition date. So this is also I have explained. So third one, recognize and measure the assets and liabilities and non-controlling interest, and recognize and measure the goodwill or gain from the bargain purchase. That means when the business organization entered into the business combination through the mergers and acquisitions, that is by purchasing an assets and liabilities from the another company, that must be represent. So that is the major objective in reporting the financial statement. The business organization must be recognize and measure the assets and liabilities and non-controlling interest, recognize the measure any goodwill if it gains or any gains from the bargaining purchase. So in this third one, that is the in third point you wanted to know, that is non-controlling interest, right? Okay, see, That means the non-controlling interest. See, company A has the 100% assets or liabilities or shares and equity. Okay, so this is my company. So L is my company. I am going to invest some of the amount in company A, or I am going to invest 40% in company A. Then my share in this A company is 40%, and wait, and the company A shares now it will be going to change as 60%, because I am going to invest in A company 40% and company A has changed their share is 60%. So from this 100% I am purchasing 40%, because of purchasing this 40% I have a rights to control only on 40% of assets and liabilities of the A company. So this 40% is a controlling interest for my business, and this 60% is non-controlling interest for my business. Okay, so this is the concept, controlling and non-controlling interest. So that must be recognized. So that must be recognized in the financial reports. So the third one, the organization must be recognize the assets and liabilities and non-controlling interest and recognize the any goodwill or gain from the bargaining purchase. So this is the another objective. Next, third one, the another objective is to proper presentation of the financial reports to the authority based on Indian Accounting Standard 103 accounting policies. So last one, the another objective, the proper disclosure of the accounting policies related to the business combinations. So we have to consider all the accounting policies, and we have to consider all the accounting policies whether it satisfy the condition of the business combinations or not. So these are the various objectives of Indian Accounting Standard. So thanks for watching. In the next classes we are going to discuss in deeply the mergers and acquisitions and its accounting policies. Okay, thanks for watching.